On a traditional stock trading floor, capitalism is, it's incredibly loud.
Oh, absolutely. It's totally chaotic.
Right, screens flashing, people are just shouting across the room, algorithms firing off in milliseconds.
Yeah, it's a very visceral environment.
Exactly. It's totally driven by immediate results.
Yeah.
But if you look at a schematic for a hydrogen fuel cell, it is the exact opposite.
It's completely silent.
Yes, silent and precise. You just have protons moving across a polymer membrane.
Right. There are literally no moving parts, no combustion.
No noise whatsoever. And today, we are looking at a deep dive into the Q2 2026 earnings call for Ballard Power Systems.
Ticker BLDP for those following along.
Yep, BLDP. And this call is where those two worlds, the loud trading floor and the silent technology, violently collide.
It really is. The tension there is fascinating.
Because the big question for you, the listener, is whether this elegant silent technology is finally making enough noise on the balance sheet to turn a profit.
And that's what everyone wants to know.
Okay, let's unpack this, because for anyone holding this stock, or even just watching the broader energy transition, the raw numbers from CEO Marty Neese and CFO Kate Igbalode are signaling a massive structural shift.
They definitely are. The narrative is changing fast.
So we are putting all the corporate spin aside today. We're digging straight into the mechanics of their performance.
Best place to start is always the immediate scoreboard.
Right. Because the scoreboard is ultimately what dictates survival in hardware manufacturing, isn't it?
Exactly. I mean, you can have the most elegant engineering in the world, but if the unit economics just don't scale, the market will completely starve you of capital.
They'll just cut you off.
Yep. So looking at the top line data for Q2, Ballard reported $20.6 million in revenue.
Which honestly is a pretty solid number.
It is, especially in the context of our current tight macroeconomic environment.
Right, where capital expenditure for heavy industry is being scrutinized to death.
Exactly. So securing a 15% year-over-year growth rate there, that demonstrates that their core commercial markets are actually deploying real capital.
They aren't just, running cute pilot programs anymore.
Right. They are putting real money on the table.
And digging into that 20.6 million, the geographic breakdown is where I think the real story starts to take shape.
The North American numbers, right?
Yeah. North American revenue didn't just grow, it effectively went vertical.
The jump was massive.
They posted $15.7 million in North America alone.
Wow.
Which is a 111% growth rate compared to the prior year.
111%. That's not incremental growth.
No, it's explosive. And when you see triple-digit top-line growth in a specific region, it usually means a bottleneck has been broken, right?
Oh, without a doubt. Management attributed this to increased adoption rates across mobility and stationary applications.
So we are talking about heavy-duty material handling, transit buses, stuff like that.
Mm-hmm. Exactly. Transit buses and stationary power generation are finally hitting this inflection point.
Meaning fleet operators are actually buying in volume now.
What's fascinating here is the transition from prototype to fleet-level procurement.
Walk us through what that actually looks like on the ground.
Sure. So for years, a transit authority might buy, say, 2 hydrogen buses just to test the waters.
Right, using some government grant money.
Exactly, effectively running a science project. But a 111% growth rate indicates we are moving way past the science project phase.
They're looking at the long-term math now.
Yep. Fleet operators are looking at the total cost of ownership over a 10-year horizon. They recognize the uptime benefits, and they're placing actual follow-on orders.
They are committing to the infrastructure.
They are.
But, top-line growth means absolutely nothing if you are bleeding cash to achieve it.
Very true. We see that all the time.
So let's look at the profitability metrics. Their non-GAAP EPS came in at a loss of 7 cents per share.
Which is an improvement.
Yeah, because in the prior year, that was a loss of 8 cents per share.
Right.
Shaving a penny off the loss translates to their overall net loss narrowing to $20.3 million for the quarter.
Down from $24.3 million last year.
Exactly. So they effectively plugged a $4 million leak in a single quarter.
While simultaneously growing revenues by 15%.
Which is wild. How do you pull that off in hardware?
Well, it requires immense operational discipline. I mean, hardware companies often fall into this trap of scaling their operating expenses linearly with their revenue.
Like they sell more units, so they just hire more middle management.
Exactly. They lease more office space, add administrative bloat, and the net loss just stays completely stagnant.
Or it even widens in some cases.
Right. But Ballard dropping their net loss while expanding the top line shows actual operating leverage taking hold.
Which brings us to the number that made me completely stop reading the transcript and rerun the math on my calculator.
I know exactly which number you're talking about.
The margin shock.
Yeah, the gross margin was incredible.
Ballard's gross margin for the quarter hit a positive 20%.
Which is a huge deal for them.
A massive deal. Because last year, in the exact same quarter, their gross margin was negative 8%.
That is a 28-point swing in 12 months.
Right. They went from structurally losing money on the core cost of goods sold to a 20% positive margin.
Which is almost unheard of in that time frame for heady manufacturing.
Exactly. Now, when you, as a retail investor, see a 28-point swing in hardware manufacturing margins, you have to immediately put your guard up.
You have to ask some hard questions.
You really do.
Yeah.
You have to ask, is this real structural growth or is this just a paper illusion?
It is the single most important question to ask when analyzing this quarter.
So to understand this, I want to use a metaphor. Let's say an insurance company realizes that a town they cover suddenly stopped having car accidents.
I like where this is going.
They get to take all the money they were legally hoarding to pay for those expected crashes, and they put it straight back into their own bank account as pure profit.
Right. It's a massive windfall for them.
But you have to ask, did the town actually become safer, or did the insurance company just change their accounting assumptions?
Exactly. And CFO Clayt Igbalod's comments on the call reveal that for Ballard, it's actually a combination of both.
It's real improvements plus an insurance windfall.
Yep. Let's start with the real manufacturing improvements first.
Yeah. What did they actually do on the factory floor to stop losing money on every unit they shipped?
Well, the structural margin improvement, the part that is highly repeatable, comes down to the mechanics of building a proton exchange membrane, or PEM, fuel cell.
Okay, let's break that down for the listeners.
At its core, a PEM fuel cell is just a marvel of chemistry. You are feeding hydrogen gas into an anode and oxygen into a cathode.
Right.
The membrane in the middle only allows positively charged protons to pass through.
And the electrons get blocked, right?
Exactly. The electrons are forced to travel through an external circuit.
Which is what generates the electricity.
You got it. And then they recombine with the protons and oxygen to create pure water.
Right, and historically, the bottleneck has always been the catalyst required to force that chemical reaction to happen quickly enough to generate meaningful power.
Yes.
You usually need platinum, which is incredibly expensive.
Very expensive.
And you need a highly complex manufacturing process to coat the membrane evenly so you don't waste that precious metal.
Precisely the issue.
Yeah.
And the CFO specifically cited product cost reductions and lower manufacturing overhead costs on the call.
So translating that from earnings speak into engineering reality, what does that actually mean?
It means Ballard has optimized their catalyst deposition processes.
So they are likely using less platinum per square centimeter.
Exactly, while still achieving the exact same power density.
That's huge.
And furthermore, as they scale up production to meet that 111% North American demand,
their fixed costs get diluted, right?
Exactly. The factory lease, the heavy machinery, the baseline utility bills, all of that is being spread across a much larger number of finished engines.
So the overhead cost per unit drops drastically.
Right. And that is the structural, permanent part of the 28-point margin swing.
Okay, so they are building the engine faster with cheaper raw material configurations and leveraging economies of scale.
That is the structural health of the business.
But we also have to address the insurance windfall I mentioned earlier.
Ah, yes. The warranty reversal.
Yeah, because the transcript notes an $818,000 warranty reversal that boosted this quarter's margins.
It did.
Explain the accounting mechanics here, because this isn't just them, finding spare change in the couch cushions.
No, not at all. The warranty reversal is deeply tied to their engineering validation.
How so?
Well, when a manufacturer sells a heavy-duty engine, accounting standards require them to set aside a liability on their balance sheet.
Like a provision.
Exactly. A provision to cover expected future warranty claims.
So if they sell 100 engines,
and historical models suggest 5 of them will need expensive membrane replacements within 2 years.
they have to lock up the cash to cover those 5 failures immediately, right at the time of sale.
Yes, and that hits their gross margin negatively upfront.
They basically assume the worst and take the financial damage on day one.
But here is where it gets incredibly bullish for Ballard's core technology.
The engines aren't breaking.
Exactly. The engines they deployed in the field are logging thousands of hours of operation, and they simply are not breaking down at the rate historical models predicted.
Wow. So the durability of their latest generation PEM technology is just vastly outperforming expectations.
Yep. And because the failures didn't happen, the accountants are legally allowed to reverse that liability.
They literally take that 818 grand out of the rainy day fund
And flow it back through the income statement, which boosts the gross margin for this specific quarter.
It's a one-time accounting bump for Q2, sure, but the underlying implication is permanent, isn't it?
How do you mean?
Well, if the engines are structurally more durable and they don't break in the field, Ballard doesn't have to reserve as much warranty cash for the next batch of engines they sell tomorrow.
Exactly. Their forward-looking baseline margins permanently elevate because the product is demonstrably tougher. We connect this to the bigger picture. Durability is the entire ballgame for heavy-duty mobility.
Right, because a transit bus operator doesn't care about the elegance of proton exchange.
They care about uptime, period.
If a hydrogen bus is constantly sitting in the depot waiting for a fuel cell stack replacement,
The operator will just buy a dirty diesel bus instead.
they'll just give up on clean tech.
Right. So the financial warranty reversal is really the ultimate proof point that Ballard's technology handles the brutal reality of commercial use.
And they are achieving all this while aggressively cutting the corporate fat, too.
Their OPEX cuts were impressive.
Yeah. Operating expenses dropped 34% year over year to $20.9 million.
That's a massive trimming of the fat.
So let's synthesize this immediate scoreboard for you listening right now. Ballard grew top-line revenue by 15%.
Check.
They exploded North American growth by 111%.
Check.
They flipped gross margins positive by 28 points due to cheaper manufacturing and highly durable tech.
Check.
And they ran the entire company on 34% less cash.
It is really a textbook demonstration of a company maturing from a cash-burning research and development outfit into a disciplined commercial manufacturer.
But, stopping the cash bleed on the manufacturing floor doesn't buy you a completely new market.
No, it doesn't. Being a disciplined component supplier is still a tough, low-margin existence.
Right. So to truly alter the trajectory of the stock, they took their balance sheet and they completely rewrote their business model.
Which brings us to the centerpiece of the Q2 call.
Yes. The transformative acquisition of GeoPura.
This is massive.
Ballard is deploying a ton of capital here, and we really need to understand exactly what they are buying.
The GeoPura acquisition is the pivot point for the entire company's valuation going forward.
Give us the raw numbers on the deal first.
So Ballard is acquiring GeoPura for a total upfront consideration of 275 million British pounds.
Which breaks down how?
It breaks down into roughly 82.5 million pounds in cash and 50.8 million shares of Ballard stock.
Okay, so this is definitely not some minor bolt-on acquisition to eliminate a tiny competitor.
Not at all. This is a fundamental rewiring of their identity in the energy ecosystem.
Let's use an analogy to ground this for the listener because it's a huge shift.
Go for it.
For decades, Ballard has been an engine supplier. Think of them like a company that manufactures a highly advanced, ultra-efficient gasoline engine and then sells that bare engine to a car maker like Ford.
Right.
Ballard makes a 15% margin on the engine and then they walk away.
Their part of the transaction is over.
Exactly. Then the car maker makes money selling the vehicle, the gas station makes money selling the fuel for the next 10 years, and the mechanic makes money on the maintenance.
But Ballard historically only got that one-time sale of the component.
Right. But with the acquisition of GeoPura, that entire dynamic flips.
It turns the model upside down.
Ballard isn't just selling the engine anymore. They are buying the entire rental car fleet, they are buying the maintenance contracts, and they are buying the gas stations.
You're describing the strategic shift from a component supplier to an energy as a service, or EAS provider.
Wall Street loves the as-a-service moniker.
Oh, they eat it up. We see it everywhere in software. But applying it to heavy industrial hardware requires a very specific operational model.
So how should listeners conceptualize it here?
Listeners should think of energy as a service as a subscription box for industrial scale, off-grid electricity.
I want to dive deep into the daily reality of that because the logistics of off-grid power are usually a total nightmare for the customer.
Oh, they are awful.
Let's say you are a site manager building a massive infrastructure project like a new highway overpass. or you're running a live broadcast for a major sporting event.
You need a tremendous amount of reliable power.
And you need it in a literal dirt field where there is no electrical grid.
Right.
Historically, what does that customer have to do?
Historically, that site manager has to engage in massive capital expenditure and logistical planning. They have to purchase or lease a massive diesel generator.
A genset.
A genset, exactly. Then they have to contract a totally separate company to constantly truck in hundreds of gallons of diesel fuel every single week just to keep it running.
And they have to deal with fuel theft.
Which is rampant on construction sites. It's a huge problem.
Plus, they have to deal with local noise ordinances because those diesel generators are just deafening.
And you can't forget the particulate matter, the PM 2.5 emissions that are just choking their workers on site.
And if the generator breaks down,
the entire construction site grinds to a halt while they wait for a specialized mechanic to show up.
It is a massive friction point. The customer doesn't want to be in the power generation business. They just want to build the highway.
Exactly. And that is where GeoPura's energy as a service model enters the chat.
Okay, so under this model, the customer doesn't buy a generator.
Nope.
They don't source fuel.
No.
They don't hire mechanics.
None of it. The customer simply signs a contract that says, I need 500 kilowatts of uninterrupted power from June to December.
And that's it.
That's it. GeoPura rolls up a hydrogen power unit, or HPU.
And inside that HPU is a Ballard fuel cell.
Yes. And GeoPura supplies the compressed green hydrogen fuel for it. GeoPura monitors the unit remotely via telemetry. If something goes wrong, GeoPura fixes it.
So the customer merely pays a flat rate for the guaranteed electricity that comes out of the wire.
It's that simple.
They are monetizing the equipment rental and the recurring fuel sales simultaneously.
Yes, they're capturing both revenue streams.
As CEO Marty Neese stated on the call, customers are demanding 6 nines of reliable power without the complexity of managing hardware and fuel logistics separately.
6 nines. That means 99.9999% uptime.
The power basically never drops.
Never.
And because it's a hydrogen fuel cell, it runs completely silently.
And the only exhaust is water vapor.
It's brilliant. You eliminate the noise complaints, you eliminate the diesel theft, and you eliminate the emissions.
This raises an important question, though. How does integrating this model actually change the financial math for Ballard?
Right, because we are analyzing a company that just reported $20.6 million in quarterly revenue.
And they're bolting on a business that completely reshapes their cash flow profile.
Management introduced a very specific framework on the call to quantify this shift, right?
They did. The 3-5-10 framework.
The 3-5-10 framework. This is the core thesis they're pitching to institutional investors, and we need to tear it apart to see if it holds weight.
Let's do it.
Let's start with the 3. Management claims GeoPura will deliver 3x growth. What is the baseline here?
The 3x growth metric refers to accelerating Ballard's combined revenue trajectory.
Okay.
By acquiring GeoPura's high-growth leasing model, which already has a massive foothold in the UK, Ballard expects to triple their baseline revenue growth rate.
Triple it.
Yes. And what is critical to understand is that management stress this projection is grounded strictly in GeoPura's current organic growth trajectory within the UK market.
Oh, wow. So it does not factor in the upside of expanding these HPU rentals into North America.
Nope. It is a highly conservative baseline.
So merely bolting on the existing functioning UK rental business triples their growth speed.
Yes.
That leads us to the 5 by value capture.
This goes straight back to our engine supplier versus rental fleet analogy.
Right. I'll take this one because the math here is just staggering. As a standalone engine maker, Ballard captured roughly 15% of the total economic value chain on a $1 per megawatt basis.
They sold the bare fuel cell, made their margin, and left the rest of the money on the table.
Exactly. The customer went out and paid someone else for the hydrogen fuel, paid someone else for the inverter, and paid someone else for the maintenance.
But now, as an integrated fleet owner operating under the EAS model,
they capture over 75% of the value chain.
It's a massive leap.
They are supplying the fuel, they own the asset, they are charging for the maintenance, and they are collecting the recurring revenue for the electricity itself.
They literally multiply the revenue they squeeze out of every single deployed megawatt by 5.
They aren't just taking a bigger slice of the pie, they bought the entire bakery.
Huh. Exactly. Which brings us to the 10x market expansion.
Right. Where does this massive total addressable market actually come from?
Well, historically, Ballard's entire corporate focus has been heavy-duty mobility.
Their primary customers were transit authorities buying buses.
Like their FC Move modules going to New Flyer and European rail companies testing hydrogen trains.
It's a great market, but it's inherently limited by how fast cities want to replace their transit fleets.
Right, it moves at the speed of municipal bureaucracy. But acquiring GeoPura throws the doors wide open to massive, entrenched industrial markets.
The CEO cited an estimated $300 billion installed base of dirty diesel gensets globally.
With an annual replacement rate of $16 billion.
It's $10 billion a year. So every single time a construction company, a hospital, or a mining operation retires an aging diesel generator, Ballard wants to drop an HPU in its place.
That alone is a $16 billion a year hunting ground.
That's massive.
Furthermore, they are entering the $20 billion hydrogen fuel supply market.
Let's talk about that because this is a critical piece of the puzzle.
It really is. GeoPura doesn't just buy hydrogen from a third party, they produce it.
Oh, they do?
Yes. They utilize electrolysis, which is using renewable electricity to split water into hydrogen and oxygen.
Right.
And they operate the largest hydrogen distribution fleet in the UK.
So by acquiring GeoPura, Ballard is officially becoming a vertically integrated fuel distributor.
Exactly.
So you combine the diesel replacement market, the fuel distribution market, and the heavy-duty mobility market, and you get a 10x expansion of their total addressable market.
3x growth, 5x value capture, 10x market expansion.
On paper, in a PowerPoint presentation, it looks flawless.
That looks perfect.
But let's introduce some reality here. Let's look at the historical bottleneck of the green energy transition.
Cost.
Yes, cost. Environmental elegance usually loses to brute force economics.
Unfortunately, yes.
If a construction site manager has to choose between a dirty diesel generator that costs $1,000 a week to run or a silent, clean hydrogen unit that costs $3,000 a week to run,
they're going to hold their nose, buy the diesel, and just ignore their corporate climate pledges.
Exactly. So how is Ballard actually convincing customers to switch?
They're convincing them through raw economics.
Really?
Yeah. The CEO used a very specific phrase on the call. Cost parity now.
Cost parity now.
They are not waiting on a magical technological breakthrough in 2035 to make this affordable.
So it's affordable today.
In specific regions with supportive government frameworks, running a GeoPura HPU is economically identical to, or cheaper than, running a diesel incumbent today.
Okay, the transcript heavily leans on the UK's HAR program to justify this cost parity.
It does.
Let's not gloss over this because regulatory frameworks make or break energy companies. What exactly is the hydrogen allocation round, and how does it manipulate the unit economics for GeoPura?
So the hydrogen allocation round, or HAR, is a flagship policy mechanism from the UK government designed to kickstart the low-carbon hydrogen economy.
Okay.
It operates on a principle called a contract for difference, or CFD.
How does that work in plain English?
Essentially, the production of green hydrogen via electrolysis is currently more expensive than just pumping fossil fuels out of the ground.
Right, the base cost is just higher.
The HAR program bridges that gap. The government strikes a guaranteed strike price with producers like GeoPura.
A guaranteed price.
Yes. So if the market price for hydrogen drops below what it costs GeoPura to produce it, the government pays GeoPura the difference.
Oh, wow. Ensuring they remain profitable.
Exactly. It effectively acts as a massive de-risking mechanism.
It guarantees that GeoPura can produce and sell green hydrogen fuel to their HPU customers at a price that perfectly undercuts diesel without bankrupting themselves in the process.
Precisely. The government basically subsidizes the transition phase until economies of scale naturally bring the cost of electrolysis down.
And because of programs like HAR, leveling the playing field on fuel costs, the underlying economics of the leasing model become incredibly lucrative.
Insanely lucrative. The CEO noted that the capital payback period on these hydrogen power units is under 3 years.
Think about what that means mechanically for a second.
It's amazing.
GeoPura builds an HPU, drops it on a construction site, and collects the rental and fuel fees.
Right.
Within 36 months, those fees have completely paid off the cost of manufacturing the HPU.
Yep. But the asset, the fuel cell, and the housing has a lifespan of 15 years.
Which leaves a 12-year tail of pure, high-margin, recurring revenue.
Pure profit. Once the unit is paid off, the only costs are routine maintenance and the cost of the hydrogen fuel.
Which they produce themselves.
Exactly. It creates a self-reinforcing cash generation engine that just requires them to deploy as many boxes as possible.
Here's where it gets really interesting.
Okay.
How does a company that just reported a $20 million net loss actually pay for a £275 million acquisition?
That is the big question.
Usually this means catastrophic shareholder dilution. The company has to issue millions of new shares at a discount.
Or they have to take on predatory high-interest debt from private equity that just suffocates their future cash flows.
Right. But if you look strictly at the balance sheet provided by CFO Kate Ballard, Ballard is sitting in a uniquely fortified position.
They really are. They ended the quarter with $502.1 million in cash and cash equivalents.
Over $500 million in pure, unencumbered liquidity.
It's an incredible war chest.
They have the war chest to fund this pivot in cash. They are paying the £82.5 million cash portion of the GeoPura deal straight out of the vault.
And utilizing their stock for the remainder.
Right. They aren't going to Wall Street on their hands and knees begging for a bridge loan.
Management explicitly stated they have no near-term financing requirements.
For a retail investor, this removes the immediate sword of Damocles that usually hangs over growth stage energy stocks.
It really does. They have the financial runway to execute this integration, weather any macroeconomic turbulence, and deploy their HPUs without constantly tapping the equity markets just to keep the lights on.
So we have established the massive scope of the GeoPura acquisition. They are buying their way into the energy-as-a-service model.
Securing 12-year tails of high-margin rental revenue.
Utilizing government frameworks to achieve cost parity with diesel.
And funding it all with a fortress balance sheet.
The strategy is undeniably sound. But strategy is just a story until management puts hard numbers on a timeline.
Right, we need to see the guidance.
Let's transition into management guidance. If they are officially becoming a vertically integrated utility provider, what are they promising Wall Street they will deliver in the next 12 to 24 months?
Guidance is the crucible. It is where visionary CEOs have to answer to pragmatic accountants.
So what did they lay out?
Management laid out several key forward-looking metrics. Now, they avoided pinning down a specific full-year EPS, which is entirely standard given the pending close of a massive cross-border acquisition.
Sure, that makes sense.
But they provided strict operational guardrails.
What was the first metric?
The first metric was revenue weighting. They expect approximately 60% of the year's revenue to hit in the second half of 2026.
Okay, so a heavily back half loaded year.
Likely tied to the seasonal deployment of HPUs and the finalization of transit bus deliveries.
But the spending guardrails are what really caught my attention. Their 2026 OPEX is capped at $65 million to $75 million.
Which is very disciplined.
Right. Considering they just dropped their quarterly OPEX by 34%, this cap suggests they intend to maintain that aggressive corporate discipline even as they integrate GeoPura.
Furthermore, their capital expenditure, or CapEx guidance, is exceptionally lean.
What's the number?
Modeled at just $5 million to $10 million for the year. This is a vital data point.
Why is $5 million in CapEx so significant for a hardware company?
Because it proves they do not need to build new factories to achieve their growth targets.
Explain that.
Well, when a hardware company guides for, say, $100 million in CapEx, it means they are pouring concrete, buying expensive new assembly robots, and drastically increasing their fixed overhead just to meet demand.
Right, they're building massive new facilities.
Exactly. But Ballard guiding for only $5 million to $10 million means their existing manufacturing footprint. The factories they already operate has enough latent capacity to handle the 111% North American growth the new GeoPura HPU demand.
They just need to optimize the lines they already have.
It is highly capital efficient.
But the headline number in the guidance, the one that models heavily into their future valuation, revolves around synergies.
Oh, yes. Synergies.
Management boldly expects to achieve $25 million in annual run rate EBITDA synergies by 2028.
That's a big number.
I want to dissect this because synergies is notoriously Wall Street's favorite buzzword used to justify overpaying for an acquisition.
It definitely gets thrown around a lot.
Where exactly does $25 million in hard cash savings materialize just from smashing an engine maker and a rental fleet together?
Well, the savings materialize through the elimination of engineering redundancy and unified supply chain purchasing power.
Okay, give me a concrete example.
Think about the current disjointed process. Today, Ballard spends engineering hours designing a fuel cell. They sell it to GeoPura.
Right.
GeoPura then has to spend their own engineering hours designing a metal enclosure, an independent cooling system, and specialized software to make the Ballard fuel cell communicate with their inverters.
Oh, I see. They're essentially doing the engineering work twice to make two distinct products talk to each other.
Exactly. Post-acquisition, the engineering teams merge. Ballard will design the fuel cell specifically to integrate seamlessly into the GeoPura HPU chassis.
So they eliminate the need for intermediary adapter hardware.
Yes. They utilize a single cooling loop, and they write one unified software stack.
That strips out millions in component costs alone.
And additionally, there are massive cross-selling opportunities.
Right.
Ballard has deep established relationships with global transit operators. They can now walk into a bus depot and say, not only will we sell you the fuel cell for the bus, but GeoPura will build the electrolysis plant right here in your depot to provide the fuel.
Wow. So capturing that fuel revenue from existing hardware customers is what really drives that 25 million synergy target.
Exactly.
Okay, the synergy math makes logical sense. But this leads us to the granddaddy of all promises made on this call, and this is where I am going to push back hard.
I had a feeling you would.
Management confidently reiterated their trajectory toward consolidated corporate profitability by the end of 2027.
Yes, they did.
I am inherently skeptical of this timeline.
It is an aggressive target, certainly.
Aggressive is an understatement. We are looking at a company that, despite the fantastic 28-point gross margin flip this quarter, still posted a negative 9.8 million adjusted EBITDA.
True.
They are burning cash on an operating basis. They are about to embark on the notoriously messy process of integrating a 275 million pound international acquisition.
Interventions are rarely smooth.
Right. And they are looking investors in the eye and promising to be completely profitable in roughly 18 months.
It's a bold claim.
That feels like a pipe dream designed to keep the stock price artificially elevated during a transition period. Where's the mathematical credibility for that 2027 target?
If we connect this to the bigger picture, the credibility requires looking past the current quarter's income statement and focusing heavily on the forward-looking indicators provided in the transcript.
Like what?
Specifically, the backlog. Ballard reported a total order backlog of $156.6 million as of June 30, 2026.
Okay, 156 million.
And this isn't a pipeline of potential interest. These are signed, committed contracts for future delivery.
Okay, but a backlog can stretch out for 5 years. It doesn't help profitability in 2027 if the customer doesn't take delivery until 2029.
That is why the 12-month order book is the more vital metric here.
What did they report for that?
Ballard specified that $74.4 million of that backlog is expected to be delivered and recognized as revenue within the next 12 months. They effectively have $74 million in guaranteed locked-in revenue sitting on the books before they even make a single new sales call.
So they have a massive revenue floor supporting the next year of operations.
They do.
But a revenue floor doesn't guarantee profitability if the execution is sloppy. My major contention here is the geographical expansion of physical infrastructure,
Which is incredibly hard.
It is a graveyard for hardware margins. The CEO explicitly stated they want to take GeoPura's UK business model and deploy it in North America.
Right. They want to put HPUs on construction sites in Texas and film sets in California.
Yes, leveraging multinational relationships to cross the Atlantic.
Yeah.
But operating a maintenance fleet in the UK, which is roughly the size of Oregon, is vastly different than operating a maintenance fleet across the entire North American continent.
Oh, the logistics are entirely different.
If an HPU breaks down on a site in northern Canada, rolling a specialized hydrogen mechanic out there destroys the margin on that rental contract immediately.
Instantly.
How are they going to scale the physical maintenance and fuel logistics across North America without blowing up their CapEx and entirely derailing that 2027 profitability target?
It is the absolute highest risk factor in the entire thesis, and your skepticism is totally warranted.
It just seems so fraught with risk.
Hardware integration is notoriously messy, and field operations are ruthless on margins.
So how do they justify the math?
The counter-argument and the math that supports the 2027 target relies heavily on the inherent profitability of the existing GeoPura fleet.
Okay, so the UK fleet.
Right. We aren't waiting for them to figure out how to make money. GeoPura already operates a massive commercially deployed fleet in the UK, powering major non-discretionary projects.
Like what kind of projects?
The transcript highlighted their deployment at the Lower Thames Crossing, which is the largest multi-year construction project in the UK.
Oh, wow.
And they're powering the live broadcast of the PGA Tour.
So they are bringing immediate, high-margin recurring cash flows onto Ballard's balance sheet on day one of the integration.
Exactly. When you take Ballard's structural manufacturing improvements that flip their margin to positive 20%,
And add the $74 million 12-month order book.
inject the immediate high-margin rental revenues from the existing UK fleet.
And later on the $25 million in manufacturing synergies.
The sheer volume of high-margin cash flow mathematically overwhelms the current operational burn rate by late 2027.
Okay, I see how the math stacks up now.
Scaling into North America will be a logistical challenge, yes. But the telemetry and remote monitoring capabilities of the HPUs mitigate the need for constant physical mechanic dispatches.
They can predict failures before they happen and route maintenance efficiently.
Exactly.
It demands flawless execution from Marty Neese and his executive team. But I concede the underlying math works. The pieces are on the board.
They are all there.
This brings us perfectly to our final assessment. We've looked at the immediate scoreboard. We've unpacked the mechanics of the transformative energy-as-a-service acquisition.
We've scrutinized the aggressive profitability guidance.
So let's render the verdict. Based purely on the data and dialogue in the Q2 2026 transcript, this quarter is a distinct bullish signal for Ballard Power Systems.
The data unequivocally supports a bullish interpretation. The strategic evolution here is profound.
And here is the core reason why. For decades, the entire hydrogen economy has been paralyzed by a classic chicken and egg problem.
It is the fundamental standoff of clean energy.
Right. A fleet operator absolutely refuses to buy a $600,000 hydrogen bus or generator because there are no hydrogen fuel stations available to run it.
Exactly. And conversely, an energy company absolutely refuses to spend $5 million building a hydrogen fueling station because there are no buses on the road to buy the fuel.
Everyone waits for the other guy to spend the capital first, and the industry just stagnates.
It is an infrastructure deadlock.
Yes. And what Ballard is executing with the GeoPura acquisition is a unilateral breaking of that deadlock.
That's exactly what it is.
By vertically integrating, by owning the power unit and the hydrogen fuel supply, they are solving the chicken and egg problem by simply buying both the chicken and the egg.
Right. They aren't waiting for a benevolent utility company to build infrastructure out of the goodness of their hearts.
They are forcing the market to adopt hydrogen by offering a completely frictionless solution.
You need power for your construction site. We drop off the box, we produce the fuel, we bring the fuel to the box, you pay a flat rate.
It bypasses the infrastructure deadlock entirely.
That removal of customer friction is the underlying catalyst for the 111% growth we saw in North America.
When you make clean energy as easy to procure as a diesel generator, the adoption curve accelerates violently.
It really does.
So let's distill this into actionable takeaways for you, the listener. Let's start with the current holders.
Okay.
If you have BLDP sitting in your portfolio right now, what does this transcript tell you about your position?
For current equity holders, this transcript is pure fundamental validation.
How so?
Well, the 28-point margin swing proves that the core PEM technology is finally cheap enough to manufacture profitably at scale.
Right.
The $818,000 warranty reversal is third-party accounting validation that your engines survive the brutality of real-world deployment.
You are holding a company that is actively stopping its cash bleed.
They are executing a massive vertical integration, and they possess over $500 million in unencumbered liquidity to fund the transition.
So you hold your position and monitor their synergy realization in the upcoming quarters.
Exactly.
Now, what about potential buyers? If you are sitting on the sidelines looking at the macroeconomic energy landscape and considering initiating a position in Ballard, what is the action plan? And more importantly, what is the risk profile?
If you are looking to initiate a position, you are betting entirely on execution.
The risk is not the technology, right?
No, the technology is proven. The risk is corporate bloat and logistical failure.
Can a Canadian manufacturing company successfully integrate a UK-based fuel distribution and leasing model without cultural and operational clashes?
Exactly. Can they navigate the complex, fragmented regulatory environment of the United States to deploy HPUs across state lines without suffocating in red tape?
So if you are a potential buyer, you wait for the next quarter's earnings call and listen specifically for updates on the North American HPU deployment timeline.
Yes. Any delay there signals that the execution risk is manifesting.
So what does this all mean for the legacy of Ballard Power Systems?
It means they are no longer just a speculative, low-margin, tech playmaking, shiny components for future transit vehicles.
Right. They are actively transitioning into a cash flow generating, vertically integrated energy utility.
They are capturing the economics from the creation of the hydrogen molecule all the way to the delivery of the final megawatt.
But before we conclude, we have to address the wild card.
Yes, the wild card.
There is a massive macroeconomic tailwind that management briefly touched upon in the Q&A session.
And it has the potential to completely rewrite this company's valuation multiple.
You are talking about the $4 billion data center backup power market.
I am.
I'm so glad we are circling back to this because I think the market is massively underpricing this specific narrative.
They really are.
Let's spend some time on this because it is the most explosive part of the entire energy transition right now.
We have to look at the macroeconomic reality of artificial intelligence.
Right. Major tech companies, the trillion-dollar hyperscalers, are in an absolute arms race to build massive AI data centers.
And these facilities are consuming gigawatts of power.
The legacy electrical grid simply cannot handle the load.
It can't. Utilities are telling these tech giants that the interconnection queue, which is the time it takes to get permission to plug a new data center into the grid, is stretching to 5, sometimes 7 years.
5 to 7 years.
Yeah.
Because the physics of the legacy grid are breaking down.
Exactly.
You have AI server racks that used to require 10 kilowatts of power, now requiring 50 or 60 kilowatts because of the immense thermal design power of the new GPUs.
Right. Utilities literally cannot lay copper wire fast enough.
Nor can they build new transmission substations fast enough to feed these facilities.
The hyperscalers are completely bottlenecked by electricity.
They have the AI chips, they have the software, but they cannot plug them in.
Precisely. And these hyperscalers have another massive constraint: strict corporate ESG mandates.
Right. They have publicly pledged to be carbon neutral or carbon negative by 2030.
So they cannot solve their grid bottleneck by just buying 50 massive diesel generators and running them off grid.
The public relations backlash would be catastrophic.
And it violates their own climate commitments.
So they need massive off-grid, instantaneously deployable power, and it absolutely must have zero emissions.
Enter the GeoPura hydrogen power unit.
Yes. CEO Marty Neese specifically noted in the Q&A that they are actively investigating how to increase the power density of these units for multi-megawatt deployments.
Deployments specifically tailored for data centers.
Think about the mechanics of this for a second.
It's mind-blowing.
A standard GeoPura HPU is effectively a 500 kilowatt building block.
Right.
If Ballard can optimize the software and the cooling loops to daisy chain 10, 20, or 50 of these units together seamlessly,
they can offer a hyperscaler an instant, off-grid, clean microgrid.
A tech giant could theoretically build a massive AI data center in the middle of nowhere,
Completely bypass the 5-year utility interconnection queue.
and power the entire facility with a massive bank of silent, water-emitting hydrogen fuel cells.
If they successfully penetrate the AI data center market with that modular HPU approach, the 3x growth projection from the 3-5-10 framework becomes entirely obsolete.
The growth curve goes completely parabolic.
Because the demand from hyperscalers for clean, off-grid power is virtually inelastic right now, they will pay whatever it takes to win the AI arms race.
It raises a truly provocative thought to leave you with as we wrap up this deep dive.
He really does.
We are looking at a legacy industrial engine manufacturer from Canada.
For decades, they were known for powering transit buses and forklifts.
But by acquiring a UK leasing fleet and solving the off-grid clean power equation, could Ballard suddenly become a Silicon Valley darling?
Could the silent, elegant proton exchange membrane become the foundational infrastructure powering the artificial intelligence revolution?
It is a fascinating collision of old-school industrial engineering and next-generation compute demand.
It's definitely something to watch closely.
That is an incredible concept to mull over as you review your portfolio. The collision of clean hydrogen fuel cells and AI infrastructure bottlenecks.
It's a huge narrative shift.
And that is the kind of underlying structural insight you only uncover when you look past the noise of the trading floor, ignore the day-to-day stock price fluctuations, and dig deep into the silent engineering and the raw economics of the earnings transcript.
Well said.
Thank you for joining us on this Talk Tickers Deep Dive. As always, keep questioning the consensus, stay relentlessly focused on the numbers, and we will catch you next time.